It's the morning of August 5th, 2024. In Tokyo, the stock market is in free fall. By the close, Japan's main index, the Nikkei, has dropped 12.4% in a single day. That's its worst crash since Black Monday 1987. Across the Pacific, the fear gauge that traders call the VIX spikes above 60, a panic level it had barely touched since the COVID crash. And here's the strange part. Almost nobody in the West could tell you why. Because the answer wasn't really in Tokyo. The thing that broke that morning wasn't a Japanese company or a Japanese bank. It was a trade. A quiet, almost invisible trade worth trillions of dollars. And it had been sitting underneath the entire global market for 20 years. When it lurched, markets from New York to Sao Paulo shook in 48 hours. This is the story of the yen carry trade, the most important machine in global finance that you've probably never heard of. For 2 decades, the world borrowed Japan's money for almost nothing and poured it into everything else. American government debt, tech stocks, currencies on the other side of the planet. That borrowed money became a load-bearing pillar, and right now, in 2026, the two forces holding it up are being pulled apart. So I'm going to show you 3 things. 1. How Japan accidentally built a multi-trillion-dollar machine out of cheap money. 2. What actually happened when it cracked open in 2024, the proof that this isn't theory. And 3. The part that matters most, exactly how this thing is wired into your retirement account and why the fuse just got relit. Because the people who should be watching this closest aren't in Tokyo. They're the savers in New York, London, and Sydney who have no idea their nest egg is standing on a Japanese foundation. Move 1. How do you build a trade this big out of nothing? You start with the cheapest money on Earth. For roughly 20 years, from the late 1990s and then even harder after 2016, Japan held its interest rates at, or even below, 0. Think about what that means. In the United States, borrowing has cost something real for decades. In Japan, for a generation, money was essentially free. So traders did the obvious thing. They borrowed yen for nearly nothing, converted it to dollars, and bought something that actually paid, like a US government bond. That gap between what you pay to borrow and what you earn, that's the carry. Do it once, it's a rounding error. Do it at the scale of the entire global financial system, and you get a trade so big that, and this is the unsettling part, nobody can actually measure it. Estimates run from under $1 trillion in plain bank lending up past 20 trillion when you count every derivative and hedge. The number most often thrown around lands somewhere in the trillions. A machine that big that no one can size sitting under your portfolio. Hold that thought. Move 2. What happens when the cheapest money on Earth suddenly isn't cheap? For the trade to work, you need one thing above all. Japan's money has to stay cheap. For 20 years it did. Then, in 2024, the Bank of Japan blinked. In March, it ended its negative rate experiment, and in July, it raised rates again. Tiny moves, a fraction of a percent. But the carry trade is built on leverage, and leverage hates surprises. When the yen suddenly jumped, the math flipped. Everyone holding the trade had to unwind it at once, sell the stocks, buy back the yen, race for the exit through the same door. That's the 12% Tokyo crash. That's the VIX hitting a panic high. And this isn't my interpretation. The world's central bank, the BIS, named it directly. The carry trade unwind of August 2024. This wasn't a machine that theoretically might break someday. It broke. We watched it. That's our proof. Move 3. And here's where it stops being Japan's problem and starts being yours. Where did all that borrowed yen actually go? A huge share went into US government debt. Today, Japan is the single largest foreign owner of US Treasuries, around $1.2 trillion worth. That's more than the United Kingdom and well ahead of China. Those treasuries are the benchmark that sets your mortgage rate, your car loan, the government's borrowing cost. When Japanese money sells treasuries to cover its losses, American borrowing gets more expensive for everyone. And it runs the other way too. Japan's National Pension Fund, GPIF, is the largest pension fund on the planet, about $1.9 trillion, and nearly half of it is invested abroad, much of it in the same American stocks and bonds sitting in your index fund. So the wiring is two-way. Japanese savings hold up Western markets, and Western markets sit inside Japanese savings. Pull hard on one end, and the whole web shivers. You felt a little of that on August 5th. You just didn't know its name. And this is the bigger idea, the one to sit with. The danger was never really Japan. Japan is just where this particular fuse happens to sit. The real story is that the entire global market quietly learned to run on the assumption that somewhere money would always be free. The carry trade is simply the most visible bet on that assumption. Move 4. So why am I telling you this now, in 2026? Because both forces are being pulled apart again, harder than in 2024. This month, the Bank of Japan raised its rate to 1%, the highest in about 30 years, the formal end of the free money era. And yet the yen is still near its weakest against the dollar since 1986. Tokyo has spent tens of billions trying to prop it up, over $60 billion in 2024 and a record $70+ billion in 2026, and it still hasn't durably held. Here's the squeeze. The gap between Japanese and American interest rates is still wide, around 2.5 percentage points, wide enough that the carry trade is still on. But Japan's side is now rising for the first time in a generation. The thing that broke the machine once, Japanese rates going up, is happening again, in slow motion. The fuse isn't lit by a prediction, it's lit by arithmetic. But here's the part that should actually keep you up at night, and it's not the one in the headlines. The real danger isn't that we know a multi-trillion-dollar trade is about to blow. It's that we genuinely don't know how big it is. Estimates span from under $1 trillion to more than 20, an order of magnitude gap. The most important load-bearing structure under your savings is one that no central bank, no regulator, no one can fully measure, because so much of it lives in derivatives and offshore accounts that simply don't show up. We didn't see August 2024 coming. The honest answer is, we can't see the next one coming either. That's the uncomfortable truth about modern markets. The risks that hurt you most aren't the loud ones on the news. They're the quiet machines humming under everything, too big to see, too tangled to measure, wired straight into the boring index fund you were told to buy and forget. You don't have to trade the yen to be exposed to it. You already are. So go back to that morning in Tokyo, August 5th, 2024. It looked from the west like somebody else's bad day on somebody else's stock market. It wasn't. It was a stress test, a single, sharp pull on a thread that runs straight through your retirement account. The machine got patched. The thread is still there. And right now, in 2026, somebody in Tokyo is pulling on it again. The only question left is whether you find out before the next August 5th or after. If this changed how you see your own portfolio, subscribe. This channel pulls apart one of these hidden machines every week.